Hello and welcome to BloombergQuint. We're speaking to Jahangir Aziz of JPMorgan on the sidelines of their annual conference. Of course, sidelines in this case means the comfortable sidelines of New York. Jahangir, thanks so much for joining us here on BloombergQuint.
Sure. Thanks very much.
I'll start with a couple of sort of event-driven questions. One, of course, top of mind was the Fed, and the Fed meeting seems to have telegraphed what a lot of people expected, that we will see the beginning of taper in November, perhaps going on till the middle of 2022. The market seemed to take that reasonably well. Is this taper without a tantrum? Are we set for something like that?
So look, I think, as you pointed out, this has been telegraphed for a very, very long time. I mean, we've been talking about tapering at least for the last 6 months, right? And finally, we're talking about tapering. And that we will be announcing something, that the Fed will be announcing something in November at the start of the taper. And so between now and that, let's say, there's one large event, data point, which is the October non-farm payroll. So unless the October non-farm payroll really, really disappoints, our sense is that you are probably going to see the lift-off for taper start there. There's a different question as to where they end. So we had a view that they would start in November and end by October of 22 at about $15 billion a month of tapering. If they end in July, that amount of tapering clearly is going to be larger. But again, Powell basically went back and said, look, that will depend upon what happens to data, et cetera, et cetera. So clearly there's a lot of wriggle room, and clearly the pace of that tapering will be very, very sensitive to data. I don't think they want to repeat any of the 2013 or the 2015, start and stop, or the 2017-18, hesitancy. They're not going to do any of that stuff. So I think my guess is that who knows where there's going to be a tantrum or not, but at least the Fed seems very, very aware of the fact that they need to do this in a very cautious manner, in a very tempered way, and in a way in which everybody is aware of what they're doing.
Is the risk of a reaction or an adverse reaction then more sort of prevalent on the interest rate side? Because I think there still continues to be some divergence on when liftoff happens, how quickly rates rise. Is that where the risk of an adverse market reaction may lie, if any?
So I would say that even that is being, done in a manner which is, uncharacteristic, I would say, of, the Fed in the past, right? I mean, we know that the Fed learned those lessons, and they are sort of, putting those lessons into play in terms of communication, etc. And if you look at the dot plots, right, the median dot plots, 50% of the FOMC still believes that the first lift should be in 2023 rather than end of 2022. And my guess is that if the data weakens, that people, the parts of section of the FOMC who believe that the liftoff should be in 22 very quickly will push back their first startup. So I would say that even that seems something that, is going to be very data dependent. It's not going to be something that is going to be time dependent. Remember that in the past, one of the mistakes that the Fed had made, and other central banks also make, is that they make communications, or they make their policy intentions time dependent. We shall do this by such and such time. And I think that they have very skillfully avoided that, saying that it's data dependent, which gives them lots more room to play around with the start and the stop and the pace of that normalization than, making it time dependent. And I'm glad that they have not made it time dependent.
From the perspective of the rest of the world, Jahangir, I think one concern at least 6-8 months back was that if rates start to rise in the US, you would sort of import normalization before, say, emerging markets were ready for it. For now, it seems like that fear is, at least at bay for some time.
I think that was definitely the fear in January, February of this year. But the fear of it at that point in time was very different, right? It was a fear that you would see massive global synchronized growth.
Yes.
On the back of the massive synchronized growth, we would see massive inflation taking place. And that inflation wasn't going to be just supply side disruptions. It would be genuine demand driven inflation. And therefore the 10-year rate was pricing that. And you saw that being reflected in other central banks, not in their actual actions, But if you look at the swap curves, all of the swap curves was trying to price in exactly that. But the world in the last 9 months have been shown to be very, very different. There is this Delta variant. There is this, the nature of the pandemic has shifted from being a pandemic to probably being an endemic at this point in time. There is differential responses across the globe to the pandemic, to the Delta variant. If North Asia continues to have a zero or near zero tolerance policy to Delta variant, this already has had a significant impact on global supply and global growth and on global inflation, and will continue to do so. So I think that the world has sort of realized that, that global synchronized, demand-driven, reopening, inflation going through the roof story is not there anymore. So, and that is clearly reflected in what happens to the 10-year. So if you look at the 10-year essentially has sort of stabilized around that 1.25, 1.3 level. And even though we do expect the 10-year to move towards 1.75 towards the end of the year, it's about a 30, 40 basis point very gradual move. And a 30, 40 basis points very gradual move is unlikely in the absence of some other shock also happening. Unlikely to force emerging market central bankers into a premature tightening. What might force them into premature tightening is their own domestic problems. So Brazil is having financial stability issues, it has fiscal issues, it has electoral uncertainty. Russia and Central European emerging market countries like Hungary, Czech Republic, Poland, etc., they have a genuine demand problem because there's no slack in the economy. Countries like India and Indonesia's and the Taiwans and the Singapore and the Chinas of the world, we are looking at, where slack will continue to be there for an extended period of time. Delta variant is still prevalent. We still have issues with, trying to figure out when exactly will the exit take place. And there, clearly, the central banks are under less pressure from inflation and financial stability issues, and therefore they will be much more reluctant to hike. In fact, in China right now, we think that they are going to ease policy. So I think it's now much more differentiated. Okay. And I really don't think that a 35, 40, 50 basis points hike in the 10-year or increase in the 10-year rate is going to derail any of that stuff. Those who are hiking or are being forced to hike aggressively are doing it because of their own domestic issues and not because the Fed is going to force them to do.
Fair enough. And I'll get to that in a minute. Help us talk through this China issue, the Evergrande issue. I think, headlines keep coming up. Wall Street Journal reporting this morning that local authorities have sort of been cautioned that there could be, default and, hence the subsequent events that follow. The financial market contagion impact versus the real economy impact, how do we judge those?
Right. So I'm glad that you sort of separate the two of them out in that way, because I think that's the way we are looking. There is a financial impact, and then there is a real activity impact. So let me just begin by saying, how are we looking at Evergrande issue in the context of what is happening in China? We actually think that Evergrande, not per se Evergrande, but allowing corporates to default, allowing large corporates and medium-sized corporates to default is simply a continuation of a policy that was started in 2018. In the case of this default strategy or default policy, so to speak. And that default policy was something that the market always wanted. In the absence of default, there was this very strong implicit guarantee assumption in Chinese corporate credit, etc., such that, credit market did not differentiate or could not differentiate between a good credit and a bad credit. If you look at the ratings of, Chinese corporates, or if you look at the prices of corporate bonds, they're like, they're bound together in the very, very small little band, right? I mean, and as a result, there was very inefficient pricing taking place. But so this was something that the market itself was exhorting the government to do, and the government was doing that in a very controlled manner, letting, certain defaults to take place, certain defaults not to take place. And we see Evergrande or Evergrande-like sort of decision, which is allowing corporates to default in that same context. This is not very different. Now, it's a different thing altogether to say that, why did they choose the largest developer to make that point? And I think that there is a sense that this is being used as a signal. This is being used as a signal that there is nothing too big to fail in China. There is no more implicit guarantees from the state. And I think it's a signal to the other corporates that you cannot continue with weak balance sheets and then expect the state or the market or the banks to bail you out. That is not going to happen. So start fixing your balance sheet, start doing your debt restructuring on a voluntary basis and getting your balance sheets in order. So that's the way we're looking at the policy intention of that. So in terms of what is the impact on activity, well, the impact on activity per se is not going to be very large, simply because if that was the case, then we will also have to say that in the second and third quarter, Evergrande was actually contributing to China's activity. Well, Evergrande wasn't really selling any apartments. If it was selling apartments, in that case, it wouldn't be in this trouble. Evergrande wasn't doing any investment, given the fact that the leverage was so high, no bank was lending any money to Evergrande. So Evergrande wasn't participating in the investment process. Evergrande was not even paying its employees because the employees apparently, these are news reports, were actually taking their own savings and putting money into Evergrande to save Evergrande. So the contribution of Evergrande in the second and third quarter wasn't very much. So why should all of a sudden the formalization of that process suddenly have a negative impact on activity? So even Evergrande per se is not where we are fearing. We are fearing that activity will slow down for a variety of other reasons, which has nothing to do with Evergrande. The financial side impact, again, is reasonably limited, right? And we need to separate between, the market seems to be confused between what is the credit liabilities versus what are the other liabilities. The credit liabilities, bonds and bank loans, etc., it's about $89 billion equivalent. That's about 0.2% of China's assets. So don't really think that will become a systemic risk. Is probably going to have an impact on two smaller banks, probably a little bit more, but not systemic. Then there's a $300 billion of liabilities that Evergrande has to the people whom they got deposits and did not deliver apartments, suppliers, SMEs, etc., etc. And I think there will be some form of debt restructuring or asset selling that will take place in order to pay them back. But that's a separate issue. That has nothing to do with the financial sector issue. The financial sector exposure, Evergrande per se, is just $89 billion equivalent, and it is 0.2% of Chinese banking assets.
Understood. Jahangir, I do want to get to India before we run out of time. So, you were pointing out the multi-speed sort of global economy, multi-speed monetary policy adjustments in different directions in some cases. So in some way, there is no one EM theme this time around,
no.
Perhaps rightly so. And India is at almost at one end of the spectrum, perhaps quite reluctant to normalize, being quite cautious on growth, even though there are some sort of incipient inflation signals. How do you right direction?
So, I mean, this won't surprise you, but we remain very concerned about the fact that the narrative in India is a narrative which probably has very little to do with reality. And the narrative is based on an antiquated method of looking at GDP, which all advanced countries have abandoned 30 years ago. And almost every emerging market country of reasonable size, Brazil, China, etc., have abandoned 10 years back. If you look at OIA year-on-year numbers, then yes, India grew 20% this year, but that has 20% last quarter. That has nothing to do with reality. This was the quarter in which Delta variant had its biggest impact. If you look at the way in which other countries actually do measure growth, which is sequential quarterly growth, when we say US is growing at 5%, we mean that US is growing 5% on a quarterly basis, yes. Then this last quarter, second calendar year, first quarter of the fiscal year, India growth was minus 23% quarter on quarter. The massive V-shaped recovery that took place did take place. It took place in the third quarter of 21, fourth quarter of 21, first quarter of 21, of 20 and first quarter of 21. India's V-shaped recovery has overdone. There is no V-shaped recovery that is happening. And this entire narrative that we are looking at a V-shaped recovery essentially becomes very problematic if you're also basing policies on that. Because, it doesn't really matter whether I think it's a V-shaped recovery or not. What matters is whether the government policies are being framed based on that. And I think that the wrong narrative is pushing the government towards adopting wrong policies, particularly on the fiscal front. That India chose not to provide income support in last fiscal. India chose not to provide income support in this fiscal year. India instead chose to do infrastructure spending as a way of providing support to the economy. If I look at where is the biggest damage in the economy, it is the likely massive and extensive damage to households' balance sheets and to SME balance sheets, not the listed companies' balance sheet. They're doing wonderfully. It is there where the impact is going to be, and we are not seeing the impact because of generosity of the RBI in extending forbearance. But one day that forbearance will go away. One day we will see that. And my fear is that the lack of income support 2 straight years is going to be directly or indirectly, partly responsible at least for a potentially large permanent scarring that can take place in Indian balance sheet, and that is going to hamper medium-term growth significantly. So that's where my worry is. My worry is not so much, whether RBI should normalize and not normalize, etc. I think RBI, within its own restraints and constraints that is imposed on its policies and what its objectives are probably juggling too many balls, but they have been juggling too many balls for a very long time. But they're doing a reasonable job juggling too many balls. None of the balls have fallen down, crashed so far.
So perhaps then if one looks at it from the lens that you're saying, there is less reason to be critical, as you're saying. Some of us locally are quite critical of the fact that they are lying 12 lakh crore or so, somewhere thereabouts of liquidity surplus, ultra low 3.35% reverse repo rate, which is an emergency rate. So maybe they have some justification in that approach, given that you're saying that there's no support from the fiscal side. We're overreaching on monetary policy.
I would definitely say, look, whether RBI has voluntarily taking the responsibility, or the RBI has been that responsibility has been imposed on the RBI. RBI is today asked to take care of inflation, take care of growth, take care of exchange rate, take care of the 10-year rate, and by RBI's own logic, take care of the yield curve. You can't do all of these. I know we always had that, but I'm saying that there was a brief period of time, I will admit, where we did think that we would focus more on 1 or 2 objectives and leave the other objectives to other agencies of the government. In the pandemic, I think we have gone and said, okay, you're again back to where used to be. So all of this talk about inflation targeting, etc., have been pushed out, and we are back again to a world in which we are being asking them to do. Now, again, whether it's voluntary or we asking them to do so, that is the reality is that they're doing. If you're going to juggle that many number of balls up in the air, to say that you have to juggle them in a matter that is perfectly calibrated, i.e., well, you can't have, you really need to make sure that the liquidity is only 5% of debt, and that your the reverse repo rate is only 25 basis points below your policy rate, and the rupee is exactly at 73, and the 10-year is between 6 and 6.25 is an impossibility. Right. So we'll have to look at this as an overall picture and say, are there some areas in which they're doing things or they're being forced to do things which are excessive? Is this thing. Now, the one area where I think they are being forced to do things that perhaps is reaching a point of excessive is the amount of liquidity in the system. You can't have that amount of sustained excess liquidity in the system without that liquidity finding some other place to go into. It is not going into inflation the way we think about it, consumer inflation, but I would definitely say that it is going into asset prices. It is not going into real estate, but I can't imagine how one justifies where Indian equity prices are without making a direct link to how much excess liquidity the RBI is putting in the system.
I asked someone the other day, Jahangir, and I'll repeat that question to you, is FIT, or flexible inflation targeting, threatening to go the FRBM way, whether it's glide paths being set or things happening outside the committee purview? Not looking great.
No, but look, we have to go and think about what the drivers of inflation are, right? I understand inflation targeting needs to be much more disciplined, and I take that point. We have been talking about this for ages, etc., etc., etc. So I'm not a fan of having too much flexibility in inflation targeting. That sort of defeats the purpose of having an inflation or having any target if you're going to move the goalpost every 2 minutes, right? But this is very different. The pandemic is not like a standard business cycle. If this was a standard business cycle, I would completely agree with you. What exactly is the RBI doing? This is a pandemic. We don't know how to react to a pandemic. The last time we had a pandemic was in 1918. RBI didn't exist at that point in time. So we don't know how to react to a pandemic. We have to do basically things by trial. And we're doing things by trial. And by the way, I am glad that the RBI is not panicking and looking at supply side inflation pressures, that core inflation is sticky or supply side inflation is sticky, and saying, okay, I need to start raising rates at this point in time. I'm actually glad that they're doing it. Now, can they continue to have that restraint? I don't know. I mean, it will depend upon what the other parts of the government is doing, and particularly what fiscal policy is doing. So again, given the circumstances, I think RBI is doing, I know that we are not happy exactly how they're juggling the balls, many of us, but they are keeping the balls up in the air. None of them have crashed. One place where I would be particularly concerned that it might go in that direction is the amount of excess.
Jahangir, one quick last question, and this is on the impending sort of inclusion in global bond indices. People think it's coming closer, and there is a lot of anticipation of that having meaning a big change for the domestic bond markets. How do you think about this? Because it seems like those 6% macroprudential limits that we had set for foreign holding in government bonds will go out of the window once this FIR and global bond listing happens.
Right. So I think increasing, and we have argued about that for a long, long time, that look, increasing the base of your bondholders is actually a good thing rather than narrowing the base of your bondholders. So, number one. Number two is that, India or any other country in the world, who go out and seek out capital, right, cannot possibly decide that there's one particular capital that I want. In this case of India, equity and FDI, etc. You have to sort of think about, what is the world offering you? If the world is interested in doing fixed income investments, then sorry, you have to allow them to do fixed income investment, right? I mean, and I think that if I go back and look at what China's experience has been over the last, I would say, about 14 months, and China will be entering the WIGB now in October. China's I would say financial system, given what's happening to regulatory side, given what's happening to the equity side, has essentially been resilient only because of bond flows. The amount of bond flows in China has been extraordinary. Okay. And I think one should take solace in the fact that, if things don't really turn out to be bad, you are going to get, certain, the flows are not going to be disruptive, et cetera, et cetera, et cetera. Having said that, I think it also does something that I think, for the lack of a better word, we haven't managed to do, which is to provide an additional source of fiscal discipline that we hadn't had. If you're going to force the buyers of your bonds to be only long all the time, which is what we have done over the last 70 years, there is no one who can short or no one who can take insurance against bad fiscal policy. Once you allow people who can actually short your bonds, I think there will be an added discipline. And again, that added discipline works. We have seen how other countries in the emerging market world has got. Just neighboring country, Indonesia. Indonesia has managed to keep a fiscal deficit at below that 3% level for almost like 10, 12 years. And part of the reason is that, a significant amount of discipline has been imparted on Indonesian government and to keep fiscal deficit at that level because of the fear that, there is now a bunch of people who can actually take insurance and who can actually react to bad fiscal policy, right? I mean, right now, there's nothing you can do because the only thing you can actually do is to go long bonds in India.
All right. Okay, Jahangir, I'll leave it at that. Thank you so much for taking time to speak to us.
Sure. Thanks very much.
Thanks for watching BloombergQuint.